Hey there, Matt the Mortgage Guy, recording a quick video, and I want to talk about rules of thumb. Now, when it comes to mortgage and whether or not it's a good time to refinance, the rule of thumb is that there's no rule of thumb. And I know I've seen things online, I've heard things in videos, people talking about, you've got to save 1%. The rate's got to go down 1% to make it work. And that's the rule of thumb. Well, with mortgage, the rule of thumb is that every scenario is so unique that you can't have a rule of thumb. And I'll give you a quick example to illustrate why that rule of thumb is complete garbage. Let's take, for instance, somebody who I'm doing a refinance for who's got a $660,000 mortgage and they had a 4.125. We're taking that loan down to 3.375. So on that big of a loan amount, we're going down less than 1%, but they're saving $280 a month. We did the analysis over the life of the loan. It's going to save over $100,000 in interest. And like I do with most clients, we're not doing life of loan analysis because people aren't going to stay in their loans that long. But just in the first 5 years, that person's saving $25,000 in interest. So if they're in there for 5 years, that's going to 10x what it costs them to refi. Because remember, it costs to refinance. No matter what kind of fancy marketing people have, the title company charges you something, the lender charges you something. If they don't charge you anything, they wrap it in and charge you a higher rate. So that's the analysis that goes on to figure out whether or not it's worthwhile. It costs you a little something. Do you recoup those costs within the first couple of years? Are you going to save much more in interest than you're paying up front and rolling into the loan to get this loan? That's the analysis that's done. And the same holds true that your rule of thumb doesn't work when you've got a $68,000 loan and somebody calls me and they're in a 4.875. Okay, we can get you down to 3.5, but that's only going to save you $44 a month, and it's going to take you, 9 years to recoup the costs that it costs for this loan. So yeah, just leave this loan alone. Maybe you throw extra payments at it, pay it off sooner, but on the smaller loan amounts, there's going to be, a much bigger spread needed. And on the bigger loan amounts, you're going to see humongous savings, sometimes at half a point or 0.625 of 1%. So the rule of thumb, there's no rule of thumb, especially when it comes to mortgages. Every scenario is so unique. And the other part about it too is that it may be time to refinance and it has nothing to do with lower rate, saving money. It might be that you're looking to retire in 17 years and you want to do a 17-year mortgage. It may be that you're looking to pull out $40,000 in cash to pay off all this 24% credit card debt and you can keep your rate the same. Or maybe your rate even goes up slightly, but you pay off all that credit card debt and your whole financial picture is a lot better. So any questions at all regarding finance, please reach out to me. I'm happy to give you your personalized advice rather than rules of thumb.